said family offices allocate 29% to private markets versus 28% to public equities. The first time that private has exceeded public. Yet many advisors still think of these as alternative.
The market volatility that we've experienced over the past 5 years has been a big catalyst towards that. So off the back of that interview a lot of the world's leading family offices. A lot of them report that they're just wanting to look at alternate asset classes that can diversify away from those traditional markets. I'd say that the 60-40 at Koda did not exist.
Okay.
But a big reason why I invested with this particular manager and showed it to some of my clients as well is their access. Canva, where they got in at a 40% discount to the latest valuation.
Wow. So are you going to give us the name of the fund or
No,
are you going to
no.
the hidden secret? For the first time in history, private assets are now larger than public markets in the portfolios of Australia's largest family offices. Today on Basis Points, we're unpacking this paradigm shift in the market and how we can all benefit whether we are a family office or not. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we are speaking to Jordan Ryan, financial advisor at Koda Capital, about the increasing role private assets should play in all client portfolios and how we can navigate the more opaque private markets. Ren, good to be with you.
Bryce, good to be here. Excited for this one. Unfortunately, I'm actually not in the interview with Jordan. I was actually quite crook this day.
Yes.
So you did this one solo, which I was sad about because I was excited to talk about this topic. It is one of the biggest trends of the past 5-10 years. I mean, private equities outperformance has been a 10, 20-year story, but the increasing allocation across private markets, not just private equity, but VC, private credit, it is just a wave that continues to build and build. And at the same time, it gets more accessible and more accessible. And so what was once the domain of large institutions and endowments then became the domain of family offices and high net worths. And now it's becoming the domain of all advice clients, really. It's getting there.
It's improving.
Yeah. And soon, everyday punters like you or I will be.
Yeah, hopefully. I think there's still a bit of room to go there, but yeah, it is certainly an asset class that is becoming more accessible.
And you mentioned that for the first time ever, family offices now in Australia have a greater allocation to private markets than public equities. The numbers are 29% private markets, 28% public equities. So it's just ticked over, but that is a seismic change.
Yeah.
If you think about how portfolios were built for generations before this moment, I mean, the classic 60-40 portfolio,
Dead.
Public equities and fixed income and bonds. The idea of as you said, it's dead. It's not dead because it doesn't perform. It's just dead because there's these whole massive opportunities that are arising. And Jordan and the team at Koda Capital are sort of right on the forefront of getting Australian clients into those opportunities.
Yeah.
So I was excited to have this conversation, and unfortunately I was too sick to have it.
Well, you did miss a banger, that's for sure. Yeah, I had a great convo with Jordan about how they're approaching it at Koda, some of the managers that they're excited about at the moment, which was great. And yeah, just more broadly how they're navigating this market, and also importantly speaking to clients about getting access to private markets in their portfolios. Because as you said, it's something that has been of recent times. So speaking to some of the older clients about getting it in there was another interesting part of the conversation.
And it is more opaque and it's different. Fees are different. Disclosures are different. Lockup periods are certainly different. So it is something for all of us clients and advisors alike to get our heads around. And this conversation hopefully helps. Before we get into it, we want to say a massive thank you to our 3 launch partners here at Basis Points: SIBO, Milford, and Orbis Investments. Their support makes this show possible, allows us to keep it free and accessible for all. So a massive thank you to our 3 partners.
And for all advisors listening, a reminder that our content is accredited by the FAAA and you can get CPD points. All you need to do is at the end of this episode, click the link in the show notes, complete the short quiz, and we will email your completion certificate. All right, Ren, well, without further ado, let's jump into my conversation with Jordan Ryan, private wealth advisor from Koda Capital. Well, Jordan, welcome to Basis Points.
Thank you for having me.
So we want to start by talking about how you believe private markets have gone from the alternative asset sort of class to what you now believe is more of a traditional asset class. And we were looking at your LinkedIn before this episode because you do a lot of content on there, and a stat sort of shone. You said family offices allocate 29% to private markets versus 28% to public equities. The first time that private has exceeded public. Yet many advisors still think of these as alternative. So what's the fundamental shift that you think these advisors are missing, and why do you call them the new traditional asset class?
Well, I think there's quite a bit to unpack there, right? And I think if you look at businesses like Koda, for example, we've been operating in this space for over 10 years. So, we're a bunch of advisors at Koda Capital, and, the types of clients that we work with, these are very familiar assets to them. However, if you look across the broad wealth market here in Australia, a lot of what's able to be offered in terms of product to the end client is dictated by whether they are classified as either retail or wholesale clients. Mm-hmm. So quite simply what that means is a wholesale investor is someone that has earned over 250K of income for the past 2 years, yep, or they have net assets that are greater than $2.5 million.
Yep.
And that allows them to access a much broader set of investment opportunities compared to those that are classified as retail, which is essentially people that don't tick the box, yep, of wholesale. So just like clients, the end advisors either operate in the retail channel, mm-hmm, or the wholesale channel. For me personally, I spent 8 years in the retail channel before I hopped across to join Koda's business 5 years ago. We only deal with wholesale clients. So there's been call it a learning shift for myself over that period of time. So that would be the first point, is it's regulatory. So I don't think that, there's necessarily a fundamental shift that advisors are missing. They're just operating within the parameters that they need to operate within.
Yeah.
That is gradually changing because there is more product that is now coming to market that is getting the tick of approval that can be provided to retail investors, which I'm sure we'll talk to. And then secondly, off the back of that, if you look at, the spread across the Australian advisor cohort, we were talking about it before, that the number of advisors have gone from about 30,000 down to 12,000. A lot of those advisors do operate in that retail channel, and they may be small one-man bands, or they may have, call it 2 to 3 advisors in a practice. And it's not economically feasible for them or commercially viable to employ a big internal investment capability. So a chief investment officer, a number of analysts to sit alongside them, which we're fortunate enough to have. So there's a model out there whereby you can outsource that responsibility and that investment capability to asset consultants. So asset consultants, the way that they operate and run SMAs or manage portfolios, traditionally speaking, the investments that need to be selected when they're building portfolios have to offer daily liquidity. If they don't tick the box of having daily liquidity, which most of your private market exposures aren't offering daily liquidity if they're genuine private market exposures and they're not listed ETFs, because there's a few of those now, like our private equity leaders ETF, which invests in listed PE companies like Apollo, Blackstone, KKR, all the names that you're familiar with. Because those models don't accommodate for those types of private market investments, the end advisor who is providing these portfolios to their clients, they're just bound within the model that they operate in. And to kind of come full circle, I don't think it's necessarily a fundamental shift. It's a regulatory regime. It's also a learning curve. So I went through that learning curve myself. And I think as more and more product comes to that retail channel, advisors will have to get up the curve. But it takes a period of time, right? So it may take 12 to 24 months before they feel comfortable to then go and start talking to their clients about the new opportunities that they can begin to offer to them.
And so what is it that you think has tipped the scales here? Like family offices now allocating 29% to private versus 28% to public. Like it can't just be, what you sort of just said there, regulatory and like the space that they're playing in. Like, are there other factors that have led to this asset class or private markets now being considered more traditional or a bedrock of a portfolio?
I think the market volatility that we've experienced over the past 5 years has been a big catalyst towards that. So if you think back, 5 years ago, we went through COVID, equity markets sold off 20, 30% at that point in time in a very sharp, it was a 1 month period, call it March, where markets sold off. We've had significant world events since then. We've had Russia and Ukraine, we've had the wars with Israel, we've had a lot of geopolitical uncertainty as well.
Day.
2022, big sharp interest rate hiking cycle, which once again saw equity markets sell off, saw fixed interest markets sell off as well. So off the back of that, like if you read through a lot of these reports that get done that interview a lot of the world's leading family offices, so not just here in Australia, these are global reports that get generated. A lot of them report that around market instability, uncertainty around what the forward outlook is, and they're just wanting to look at alternate asset classes that can diversify away from, those traditional markets being your fixed interest and listed equities. But family offices as a whole, they've always been in that space, depending on what you constitute as a family office. We're talking your multi $100 million plus, not the guy that sold a business for 50 million bucks and now runs a family office, because we see a lot of those. But they've always been allocating to that space.
Interesting. And so I guess just to go back a step as well, like within private markets, like what are the big pillars of like investable universes? Like how do you define private markets?
That's a good question, because everyone does define them in certain ways. And, we look through a lot of different people's portfolios and they might just have a single bucket where they call it alternatives. And within that bucket, it is private equity. Within private equity, you've got a few different pillars. You've got buyout, you've got growth, you've got venture capital. Some people constitute venture capital as its own separate pillar to private equity. So private equity being more mature businesses, venture capital being more earlier stage. Then you've got private or unlisted infrastructure assets. So owning of airports, the necessary infrastructure that essentially sits behind an economy. So toll roads, airports, ports, railroads, everything else in between, renewable projects. Then you've got private credit, which obviously is probably the most popular by far, particularly here in Australia. It's
buzzing.
Hard to go past an AFR article these days that doesn't talk to it, right? And then, we've got an additional pillar, or one that I've missed as well, is commercial real estate. But then an additional pillar that sits alongside that would be, call it niche alternatives. So things like natural resources, but in the private space. So it might be the ownership of water rights, private energy assets, for example. Traditionally, people would probably put gold in there as well.
Crypto.
Does
that fall in there?
Yeah, it would for a niche alternative, 100%. But then again, it depends. If you're talking to crypto bros, they'd probably put it as its own asset class, right?
Absolutely. So when you're thinking about portfolio construction, given that there's this increasing role of private markets and more money's flowing into private markets, like, does that change how you think about traditional portfolio construction? Like, is the 60-40 approach at Koda dead? How do you define your portfolio construction now?
I'd say that the 60-40 at Koda did not exist.
Okay.
We were fortunate enough when the business started 10 years ago that we started with a blank sheet of paper. So, we looked across the spectrum of asset classes. We looked at all the top tier global investors, and a good example here locally is Australia's Future Fund. If you look at how they invest, they're not just investing in listed markets. So they've got a very low exposure, in fact, to Australian equities. It's about 10% of that entire portfolio. Private equity makes up about 13%. Infrastructure makes up about 10%. Then they've got higher allocation to global equities. Timberland sits in there as well. So like forestry, credit, and everything else in between. But for us, we looked at models like that, and given we had the ability to access all of those different markets, and our clients are a bit more sophisticated than the average, and they're the types of opportunities that they demand from us. So when we started our business, it was just looking across the full set of investable opportunities, and determining what model did we want to follow, and that model that our portfolio is more aligned with is what we call the endowment model, which if you look at your big university endowments like Harvard and Yale overseas and how they invest, there is a larger weighting to private assets.
Yeah.
And that's also by nature of the fact that, these endowments are very large. They've got very different liquidity requirements than the average person. So they can deploy a higher percentage of their capital into those asset classes than what, the average person can be. But, we certainly learnt from those models that if you give up and you're willing and able to give up a little bit of liquidity, there is a certain premium that you can earn for forgoing that liquidity.
And so I know you're not going to be able to answer specifically, but in general terms, if you were to try and bucket, percentage weighting towards public versus private in a general Koda portfolio, what is the split?
So to answer your question directly, I would say, we'd have anywhere from 20 to 30% in private credit. And then outside of that, if we separate it out into defensive alternatives and then growth alternatives, but there'd probably be another 10 or 15% in defensive alternatives. So that's things like unlisted or private infrastructure assets. And then alongside that, we have a third bucket that's growth alternatives that once again would be 10 to 15% depending on the individual that we're advising. One of the unique things about our value proposition to clients is that we create completely bespoke portfolios.
Yeah.
So whilst we have what we call reference portfolios, so we've got a big investment team of about 12 people that put together these core portfolios, and it's based on a risk profile, which you'd be familiar with. So call it a 50-50 growth versus defensive split, 70-30, 90-10. So 90-10 being your more aggressive, 50-50 being your more defensive. When we're building out those portfolios, they're to act as a reference, which means it's then down to us, the individual advisor, to intimately know and understand our clients. And we don't necessarily align them 100% to what our investment team may put together. If a client, for example, has a desire to have more exposure to private markets, we can dial that right up to 100% if they want to have just private equity in their portfolio. And, typically that's not our average client. They don't look like that. But if it's someone that's they're operating a business and they're a young accumulator, like I work with a bunch of people who are in business still, mid-40s and 50s. They've got an operating entity on the side. They've already paid off their home, bought an investment property, and the business is spitting out surplus cash flow. And they've still got a long runway between when they want to retire, for example. And if they're in business, they understand business, and they typically like those differentiated investment opportunities, private equity being one of them.
Interesting. So anywhere, it sounds like about 60-70% can be in private. Are you going direct into asset, or are you selecting managers?
In what respect do you mean?
Well, are you going out and actually, in private equity, making the deals yourselves, or are you investing in private equity managers?
We leave that up to the managers themselves. So we partner with, top tier, both domestic and global PE managers. They run that process. We then just allocate accordingly based on, do we want exposure to Aussie PE? Do we want exposure to global PE? Do we want mid-market exposure? Do we want large cap exposure? Venture growth, whatever it may be.
Well, I'm going to ask you at the end for a fund manager or strategy that you think is worth looking a bit further into. But before we get to that, the growth aspects of private market are well covered. Like PE, we know has historically outperformed listed equities, and and there are other asset classes in there where crypto as well has performed pretty well. Talk us through the defensive characteristics though. Like how have they performed during, for example, recent COVID? 2022, there was a down year. I think that was when we saw some of the big private, Canva was written down pretty heavily and the like. So talk us through the defensive characteristics and I guess the performance that has come from that.
Well, I think one of the biggest characteristics is that these assets aren't daily traded. So unlike your listed equities and your fixed interest that operate on an exchange during periods of stress, people tend to, run for the exit, which means that nowadays, people from their phone can literally click sell. And if enough people are selling, then, in a period of time, it certainly moves the market and it can move the market quickly. That's certainly what we saw during COVID. That's certainly what we saw during 2022. The benefit around, private markets is depending on the asset class and depending on the individual fund as well, because some of these funds will operate, if we're talking private credit, for example, some of them will operate as a bit of a hybrid. So to allow a better liquidity profile, they'll have some public market exposures in there and they blend that with private market exposures. So it might be 50% public, 50% private. Like I said, gives them better liquidity, but that also means that their portfolios will trade differently compared to a manager that's purely private only because of that listed component. But then it comes down to the individual asset class as well within private markets. So if you look at private equity, for example, during those periods of stress and how they need to report on their assets, they actually look at listed markets, and when they're valuing their companies, they have to strike a fair value. So they look at the listed equivalent within the particular sector that their individual portfolio companies are operating in, whether that be, call it financials, communications, IT, whatever it may be. They look at the listed equivalent. So when, if we're looking at, say, 2020, when listed equity markets sold off, call it 20, 30%, private equity was down about 10 to 15% over that period of time. Right. Ended the year positively, just like listed markets. A lot of people tend to forget that during COVID. True. People go, wow, it sold off 20 to 30%. But calendar year 2020, the market was actually up. Exactly the same for private equity, despite that down period. But then if you look at, say, other asset classes such as private infrastructure, one of the managers in our portfolios, they were down about 2%. So very defensive. Wow. And that 2% came by way of the fact that they had 20 to 25% of the portfolio exposed to airports. And we all know what happened during COVID. Yeah. We went through lockdowns, airlines shut down completely. We couldn't travel or go anywhere. So if you were with a manager that, say, had 50% or 60% of their portfolio in airports, then they would have felt the pinch a bit more than, say, someone that was operating a more diversified portfolio.
Yeah, right. So how do you go about your manager selection? What's the process?
The process is run by our investment team. Okay. So as I mentioned before, they build what's called our reference portfolios. They handle all of that, but we also have an added sleeve within our business that's called our advisor-led channel. So we also have the ability to go out and source our own opportunities and work with managers that may come by way of a client that's has a relationship with a particular manager and they may be a significant client in the firm. If it's a good opportunity, some of the advisors will send that around to the other advisors in the business and say, I've got X, Y, and Z coming in to talk about A, B, and C. Yeah. I like it for this reason. Yeah. If you're interested and you want to come in and have a listen, come on in. So then off that channel, if there's sufficient demand, it has to be, a decent ticket size. We're not talking $1 million. It has to be a decent ticket size. Off the back of that, we can create a vehicle to access that opportunity as well.
All right, nice. Speaking of opportunities, off air, you said you've come in the studio today foregoing a session with Howard Marks at the office. So
it's because I love equity, mates.
Thank you, Jordan. I want to talk about the role that you play in taking the client on the journey, because obviously Basis Point's a lot of advisors listening and perhaps a few who are, have clients coming to them asking about the opportunities in private markets. So how do you find the client conversations around private markets, especially for those that sort of come in with sort of investing for a long time? They think they have sort of preconceived ideas about what good long-term investing is. How do you sort of broach that conversation?
I think exactly like my own personal experience, right? I mentioned before, I spent 8 years on the retail side of things. So when I joined Koda's business, there was a steep learning curve for myself. I spent, a good period of time in private wealth, and I never knew that some of these opportunities were actually investable opportunities. Private equity, I've been in, that space for over 13 years. I've been investing in private equity since that period of time. So I was always familiar with that. But unlisted infrastructure assets and some of those niche alternatives that we were talking to before, I myself had to, go on a journey of education. And I do the exact same thing with my clients that, a lot of these opportunities are new to them. So I try my best to try and break it down into layman's terms and relate it back to things that they'd understand. I work with a lot of people in business that are either still in business, they've sold to private equity, or they're retired and previously operated a business. So for those individuals, when you're talking investments like private equity, they just know and get it right off the bat.
Yeah.
Some of the more esoteric or niche opportunities like, say, water rights and water trading, very different. But if you've got a agricultural family that you're looking after, they're well-versed in that asset class, whereas private equity may be a bit more unfamiliar to them. So it's certainly just an education journey, but partly now what we find is because we've built a reputation around our access to the alternative space, there's a lot of publications and PR written about the business. We now have a lot of clients actually coming to us, knowing our story, knowing the brand, saying we're familiar with X, Y, and Z. We're not getting offered that through our existing advisor relationship. We'd love to come and have a conversation with you about, taking a step into the world of private markets and learning more. So I think it's twofold. It's people actually reaching out to us because they're familiar with it. And then on the opposite side, it's us actually taking the client on the education journey ourselves.
And so when a client comes on board, how do you actually deploy the capital? Like, is it all at once, particularly in things like private markets and public private equity as well, where opportunities, I imagine, aren't just sort of coming every single day. Like, how do you deploy capital all at once? Is it iterative? What's the process?
So I'll start on, because you raised that private equity and opportunities not, coming down the pipeline every single day. It depends on the private equity vehicle that you're in. So you've got your more traditional, what we call drawdown funds, where as an investor in those funds, you commit an amount of capital, then over a 3 to 5 year investment period, they go out and source opportunities. And when they find those opportunities, they come back to the investors and they say, Jordan, you committed $1 million to our fund. We found a business that we want to deploy money into. We need to call 15% of your commitment amount. Okay. So within the next 7 days, can you transfer us across 150K? And we do that on behalf of our clients. So we manage that liquidity process for them and those capital calls. Such your more traditional vehicles. Then you've got, which I'm sure you've probably heard about, but there's a rise around what we call evergreen vehicles. And it doesn't just apply to private equity. These evergreen vehicles are now in private credit, unlisted infrastructure. But if we just look at private equity, instead of that long investment period of 3 to 5 years where you commit an amount and you're gradually called on your capital, you can deploy that capital commitment on day one. So if you've got $1 million to invest, you deploy $1 million on day one, which means your investment begins compounding at $1 million from day one, which is quite attractive. But more often than not, when you're deploying into that portfolio, it may already have, because as the title suggests, evergreen, it's a perpetual vehicle. So it may already have, call it 300, 400 companies that are within that vehicle, meaning you get instant diversification from day one. So in that scenario, when we're talking about deploying capital, you can deploy straight into that vehicle. So if I then compare that to equities, very different. We typically tranche in for clients. If it's new money versus existing money, it's very different. But because of those more defensive characteristics of private markets, you're not getting the same daily volatility that you see in the listed space. You can typically go and allocate straight off the back, right away, deploy all your capital from day one.
I'm interested in the private equity space. What's your like preferred method?
In terms of the vehicle, is that what you mean?
Yeah, like there's, I'm even thinking, we've spoken with PEP and they've got their gateway, which I think is just one vehicle and one investment. So it feels like there's a lot of things coming to market, but yeah, what's your asking for a friend here?
Well, it's funny. I've done quite a bit of a deep dive around this recently and shared my thoughts on some of it, but if I look at our business as a whole, we utilize both.
Okay.
So we utilize the drawdown vehicles or closed-end vehicles, and then we use the open-ended or evergreen vehicles as well.
And so with the drawdown then, that means you've committed, but you might have a 5-year window where you've got to at least be doing something with that money. You don't want it just to be sitting there. So you're just going to have to manage that liquidity because at any moment they could be coming and saying, we want 20%.
Correct.
Yeah.
So that's managed one of two ways. You can hold it in cash. You can hold it in a fixed interest holding. Sometimes people hold it in a equity market ETF.
Yep.
So it's essentially mimicking in a way the type of returns that you can expect over the long term from private equity.
Yeah.
Or sometimes clients will just hold that cash themselves on the side, depending on the client, and you shoot them a note and say transfer across the money. And like I said, if they're operating a business and they've got high cash flow, they're more than happy to manage that liquidity side themselves. But to go back to the original question around preference, we utilize both. Some managers will only operate under the closed-end vehicles because they were the traditional private equity vehicles, these evergreen funds. Whilst we're seeing more come to market now, one of the original players in the space, they had a vehicle in place over 10 years ago, but they were first to market. You mentioned PEP before. PEP now have a vehicle, so PEP being an Aussie PE manager, very well known. They operated traditionally under closed-end vehicles. So now what they've done is they've opened a evergreen fund, which now feeds directly into every single deal that they're doing going forward. And there's trade-offs with each. There's typically a lower return expectation that you can expect from the evergreen vehicles because they also offer you liquidity. So more often than not, you'll get quarterly liquidity if you need some of your money back. Whereas a traditional closed-end vehicle, you lock that capital away from anywhere from 10 to 12 years. Yeah. So there's a liquidity premium, once again, trade-off between both. So we like to utilize both.
That's the other thing I'm thinking through. It's like, how do you think about, I guess, diversifying when you do have such long lockup periods? I guess traditionally, are you backing just one manager or are you splitting whatever you're allocating to still across multiple managers?
Across multiple managers.
Yeah.
And once again, it comes down to the client. It depends on the size of the pool of capital that you're managing. It depends on their cash flow on the outside. If you're looking after a retiree that they don't have any cash on the outside and it's all invested in their portfolio alongside of you, then it also comes down to the internal cash generation that the portfolio is generating after you subtract their pension requirements, so the money that they're taking out to spend on travel and their lifestyle requirements and everything else in between. If there's enough ongoing cash flow outside of that, then you can typically continue to allocate to these vehicles year after year, which is actually really important. You don't typically want to go into a closed-end vehicle, say, today, and that's all you do. The reason for that is that manager who raises capital today spends the next 3 to 5 years investing across the spectrum, which, an analogy that we use is, we talk about vintage diversification. It's just like wine. So when you're growing wine, not that I'm a wine connoisseur whatsoever, but when you're growing wine, right, there's different seasonality changes that take effect that impact the quality of the soil, and there's different years or vintages of wine that are better than others. It's the exact same as private equity. So if you take 2021, for example, top of the market, peak valuations, we saw, a big sell-off and going into 2022, but a lot of money was raised in 2021 that needs to be deployed, which is going to have a dramatic impact on the returns of those closed-end vehicles. Yeah. And if you only allocate to one and you allocate in 2020 or 2021 or whatever it may be, then your experience with that one private equity manager and that one private equity fund may actually not be too great, even if the manager is an exceptional manager and they've generated top quartile returns for the past 10 years, it all comes down to that vintage. Whereas the evergreen funds, you're getting instant diversification across vintages when you go into them. So if there's 300 companies in there, they may have been invested across 2018, 19, 20, 21 up until 2025. So you're getting a broader, more, it's just like your ETFs, more diversified exposure.
I guess the trade-off is with the evergreens, you might be coming in when some of the returns have already been made, versus getting in at day one and hoping that the manager goes well.
Well, like if you look at, say, a lot of these evergreen funds over the past couple of years, and you compare them to the listed equivalent. So if you look at global markets and what they've done, as you guys would be more than familiar with because you talk about it every single day, there's been a big run up in global equities, but private equity funds have actually lagged.
Really?
Yeah. So we're not talking negative returns, but instead of the 15, 20% returns that you're seeing out of listed markets, you're getting a mid to say high single digit return out of your private equity funds. But it's just quite simply because these vehicles operate, because of liquidity, they operate with a lag.
Yeah.
So valuations operate with a lag. They don't typically change on day one in line with listed markets. So what we'll see going forward is, or the expectation is going forward, with people like, say, Trump in power and Trump being pro-business and IPO markets coming back on board, you'll start to see going forward these private equity funds, because IPO markets have actually been shut, which has meant that their exit opportunities have actually been far less than what they have been in prior years. So with IPO markets now starting to reopen, you'll start to see the private equity managers be able to realize more of their investments, which just quite simply means higher returns for investors in the fund.
Gotcha. So another reason that I guess your clients come to you and a lot of advisors is for tax optimization. Talk us through how you think about like structuring or like investment vehicles, SMSFs, bucket companies, trusts, you name it, versus these asset classes. Like, are there particular asset classes that suit structures, or are the structures just dependent on client goals?
I would say no, they're not. There's not particular assets that are better suited to certain structures. I'm a certified financial planner by my background, so I bring that level of tax and structuring advice to my clients when I'm advising them. Most of my clients, by nature of the size of wealth that they're looking after, they will have, or I help them establish, a family trust, a bucket company that comes off the back of that, or a private investment company, and then a self-managed super fund as well. So when I'm running a strategy for them, just say there's a pool of capital, it's $5 million, $10 million, whatever it may be, I look at their strategy in aggregate, and then I utilize those individual vehicles to build the single strategy for them. And if, say, for argument's sake, if they've got $10 million and they only need to draw out $200,000 of income, then how I structure things is, and this is a luxury, you can't do this with all clients, but for some of those, say, private market opportunities that have high return targets like private equity, that also may have longer or extended liquidity windows, so they're less liquid investments, I'll go and structure them in the self-managed super fund. And I will have next to no income generation in the self-managed super fund, which is counterintuitive to what most people do, right? And the reason for that is, if I've got, and I'll give you a real life example, right? So I can actually put a bit of color behind this. One of my clients inherited a significant amount of money. She's someone in her early 60s, inherited money from both of her parents passing away. She had a couple $1 million in super. Then the rest of the money was through a family trust and a private company as well. So effectively what we did for her is her income need was quite low based in comparison to how much money that she had. So she only needed to draw out a couple $100,000 a year. But the income generation that the portfolio was generating was really high. So we had, and we continue to manage, a lot of her income-focused investments through the family trusts, which may be Aussie shares that generate income, it may be private credit, it may be fixed interest, and then assets that don't generate as much income and may be less liquid, like I was saying before, I actually structure through her self-managed super fund because I'm running her strategy in aggregate. So when I'm looking at the individual asset classes and how much we want to have, it's done across all the entities. It's not, I need to meet a 50-50 growth versus defensive split in the super fund, then a 50-50 in the company, then a 50-50 in the trust. It's aggregate across all the vehicles. And for her, she's at the stage now where she can enter pension phase in her super fund, but that vehicle is really tax effective because any income that gets generated and any capital growth or capital gains, once they're realized, that get generated, are taxed at either between 10 to 15%. So income tax at 15%, capital gains, if you've held it for longer than 12 months, the asset, it gets a discount. So it's taxed at a lower amount of 10%. But we actually haven't commuted her into pension phase because that vehicle that's holding a couple $1 million for her is actually very tax effective at 15%, because as soon as you convert it over into pension phase, you have to pull out a certain amount of money each year. And her income needs are well and truly met by the family trust that allocates money to her, allocates money to her daughters, and then any surplus gets allocated to the bucket company. So she minimizes, or her average tax rate sits at 30% across all of those entities. And then the super fund is taxed at 15%. So we actually don't want to be pulling money out of the super fund because she's now at a stage where she actually can't contribute a lot of money back in based on the amount of money that she has to pull out.
And so the role of the bucket company, so, you know, another case study, someone doesn't want to lock up a lot of assets or a lot of those growth assets in the super fund. Like, what's the role of the bucket company in sort of a situation like that?
The role of the bucket company, more often than not, sometimes clients will come to us where they already have money that is sitting inside that entity. So that's a different scenario. But the role of the bucket company, quite simply, is, I don't want to say the words tax arbitrage, but essentially it's a bit of a tax arbitrage, right? That the family trust, just like a managed fund, it's a trust vehicle, and trusts have to operate under certain rules where the income that gets generated or capital gains, it has to go out. So a trust doesn't actually pay an income tax rate. So it's the beneficiaries of the trust that pay a tax rate. So if you're distributing to an individual like yourself, assuming you don't earn any other income, you can earn up to 190 grand. Any dollar that you earn above 190 grand gets taxed at 47%. So we then start distributing any surplus to that bucket company, and then we start building wealth through that vehicle because it's taxed, once again, at that 30% as opposed to 47%. Then there's certain rules around that bucket company if you want to pull money out. So I've got a lot of clients that will
Special
run
dividends or whatever.
So it has to be paid as a dividend. So just like a public company, if CBA wants to reward its shareholders, it has to declare a dividend to pay that money out. A private company is the exact same. So it has to declare a dividend to pay out money to the shareholder, which may be you, the individual.
Can it be franked?
It is franked, Or it can pay out to an entity as well. So sometimes what we do is I'll have a family trust that where the bulk of the money is invested in, it spits out the surplus income to the individuals. Any surplus goes over to the bucket company. Then if you want to take money out of the bucket company after it's accumulated a lot of wealth over time, you can structure from the outset. That's really important. You structure the shareholder as another trust. So the company pays or declares a dividend to the trust, which then gives you added flexibility once again as to where it goes. And that's, I've seen clients caught out in that scenario before. Part of my role when I, bring on a new client, I look through all their entities and I get into the nitty gritty. One gentleman that I worked with, he had a lot of that already in place, which he was quite proud of. And, he was quite a sophisticated guy in business. But when I looked through his private company and how he had it structured, he actually had the shareholding as 70% to himself and 30% to his wife. And I asked him why he did that. And he said, I set it up a long time ago. At that point in time, we weren't necessarily, sharing finances equally compared to how we are today. The wealth position looked different. I controlled about 70% of the wealth. So I thought that made the most sense. But the scenario he's now got himself into, we've worked through it now, but at that stage is if he wanted to pull money out of that company, he can pull out however much he wants.
30%
but
has to go.
30% has to go into his wife's tax return and 70% has to go to him. His wife doesn't work.
Yeah.
He earns all the money. So all of the money goes into his personal name. So he's set up a vehicle for tax minimization purposes.
Shooting himself in the foot.
When push comes to shove, the only way that he can minimize his tax is if we start taking money out of that entity once he retires and his employment income ceases. So he doesn't have the same level of income coming through.
Yeah.
But even at that point in time, it's tricky because it kind of defeats the whole purpose of that entity because you want to have flexibility around, how you distribute the money.
Yeah. Well, that's what they pay you the big bucks for. So,
That's it.
So Jordan, to close out, what's one fund or strategy that you'd tell all the advisors and industry professionals listening today to go and research for the week?
I'll reframe it and I'll say I'm not going to tell anyone to go out and invest in it. But I would say, reframing the question, I would say something that I've been looking at. So not through Koda and our research team. It's something that came to me through my own network. Was actually a opportunity in venture capital.
Okay.
Up until this point, I haven't personally dove too deep into venture capital. It's a tricky asset class whereby the outcomes are quite binary in nature. It's head you in, tails you lose in terms of the portfolio companies that get invested into because they are early stage businesses. And with early stage businesses, they carry a bit more risk around, is the business model going to become redundant, in the forward-looking period? A lot of these venture capital businesses are tech-led, and tech and innovation moves fast. So we see a lot of tech businesses failing that once were really great businesses. So venture capital's always been a tricky space because I've always had access to really good quality private equity opportunities. So I've always gone down that pathway. But I've always wanted to dabble in venture capital, assuming the right opportunity comes along. So this right opportunity has come along at what I call an opportune point in the market cycle. So there are a lot of big funds out there that are needing to get access to liquidity. So there's lots of secondary transactions that are taking place, which effectively just means funds going to existing private equity or GPs and buying out some of their, call it LPs. So the people that are invested in their funds to give them access to the liquidity. So it might be buying out a big family office who has been invested with a private equity fund for 8 years, but they can no longer tolerate the illiquidity. They've had some type of event where they need access to money. So this venture capital vehicle is what we call a fund of funds. So it's actually allocating across a lot of different other venture capital funds. So you're getting vintage diversification. You're also picking up really attractive secondary opportunities based on the point in the market cycle because of their relationships in the space. So they're acting as a liquidity provider. So instead of getting into the asset at day one, you might be getting in at year 5 or year 7, where a lot of these businesses have started to mature. And, the businesses that have already gone out of business, you're not actually getting exposure to them anymore. You're getting exposure to more quality companies that have demonstrated a track record, but it's also global. So it's not just focused on Australia, which, a lot of Aussie investors were suckers for things like, investing in Aussie property, Aussie shares, because it's in our local market. Likewise for venture capital, there are a lot of really good Aussie private equity venture capital players, but our market's just not that deep. So this fund is a global fund of fund opportunity where it's evergreen, offers quarterly liquidity, gives you vintage diversification, money gets set from day one and starts compounding from day one. But a big reason why I invested with this particular manager and showed it to some of my clients as well is their access. So what they've built from the outset is they have over 100 companies already in this fund, whereby investors from day one get access to these 100 companies that are being held on the personal balance sheet of this private equity player, whereby they then roll it into this new fund. you, the investor, get in at their cost price.
Oh, wow.
So even though they might have held some of these assets and some of these assets have actually already sold, one of those examples is they invested in Wiz, which you may have heard of at the start of the year, was one of Google's
Amazing
largest
story.
transactions. And then there's other investments in there like Canva, where they got in at a 40% discount to the latest valuation.
Wow.
So whilst people, you touched on it before, Canva's got big punchy valuation. If you're buying in at a 40% discount, that provides a bit of downside protection. And then on top of that, there's more popular assets in there like OpenAI.
So are you going to give us the name of the fund, or are you
No.
the hidden secret?
Off air.
Off air. Okay, fair enough. Well, I guess do your own research and try and figure out what Jordan's talking about. Jordan, thank you so much for joining us today. It's been a fascinating conversation. Certainly, an interesting space as private markets become more and more a part of, I guess, your clients' portfolios and, I guess, of interest to a lot of your clients. So I'm sure a lot of advisors listening today got a lot out of that. So we appreciate your time.
Pleasure. Thank you for having me.